Audit planning and fieldwork. What is planning? Planning involves strategy for the audit in order to guide them in their auditing performance, such as their timing doing the auditing, so the performance will be more effective and efficient. Why audit planning? 1. They focus with their progress being more effective. 2. Able to minimize the audit cost that will incur during the performance. 3. Avoid misunderstanding with the client. 4. Minimize the legal liability that could incurred. 5. Ensure that they will have enough time regarding to the critical aspect in auditing. 6. Able to obtain the appropriate evidence. Step in audit planning. 1. Pre-planning. Client's acceptance. 2. Having the knowledge about the client business by understand the business environment and operating. 3. Knowing the business risk. 4. Perform preliminary analytical procedures. 5. Set the materiality. Client acceptance. Initial audit planning is very important in order to A. Accepting a new auditor or continuing the existing one. B. Knowing why the client needs the audit. C. Having the information regarding to the term of engagement from the client. D. Choosing the staff for the engagement. For new client, investigation are important because easy to identify. A. The client having the relationship with a previous auditor. B. The client having financial problem. C. The client are standing in the business community. The procedure to communicate with the predecessor auditor is: 1. The successor must have permission from the client in order to communicate with the existing auditor. But if the successor cannot get the permission, so he should decline the appointment. 2. The successor need to know if there is a professional reason for the proposed change. If there a reason, he have to ask from the existing auditor the detail to decide the appointment. 3. If the successor did not getting the detail, like procedure means, he or she can give a reminder to the existing auditor or he can communicate to the existing auditor. 4. But if the successor still not having the detail that he wants after giving 2 reminders, so the successor should inform to the existing auditor his intention to accept the engagement. Meanwhile, for continuing or existing auditor, they need to determine why the auditor cannot continuing to do audit for that company. Is there any conflict regarding to the scope of audit or type of opinion to issue audit fees? Why client needs auditor? There are 2 reasons. A statutory requirement. B. Weakness that state in the operation. Auditor can review the financial report that provide an overall view about the business. Why we must understand the client business. This will help the auditor to understand the nature of their client business. An auditor need compile their understanding of an engagement in the audit file. An engagement letter is an agreement between the CA and client for the conduct of an audit. Select the staff for the engagement. According to the MIA by law, it states that the member must competent the performance as a professional work, but if he is not, so he should not continue the professional work unless he obtains such advice and assistance which able to help him to complete the work. Scope of audit work. Engagement letter, fraud and error. An engagement letter explains the legal connection or engagement between a professional firm, for example accountancy firm or audit firm, and its clients. The engagement letter expresses the terms and conditions of the engagement, mainly focusing on the area of the engagement and the terms of compensation for the firm. There are several things to be added in an audit engagement letter, including the objective and scope of the audit, the duty of the auditor, the duty of management, identification of the financial reporting framework for the preparation of the financial statement, and expected structure and content of any reports to be issued. Explanation of the scope of the audit, the form of another communication of results of the audit management, the certainty that several material misstatements may not be noticed, arrangement concerning the preparation and performance of the audit, as well as the composition of the audit team and the assumption that management will give written representations should also be included. The basis on which fees are computed, a petition for management to accept receipt of the audit management letter and the terms of the engagement, arrangements regarding the participation of internal auditors and other staff, any duty to issue audit working papers to other parties, any restriction on the auditor's liability, and arrangements to create draft financial statements in planning and performing audit plan. Besides evaluating and reporting audit records, the auditors must think about the risk of significant misstatements in the financial statements, as the result of fraud and errors. Misstatements in the financial statement will occur from either fraud or errors. If the auditor receives wind of fraud or error, the auditor should communicate his discovery to management immediately. The auditor must take into account the credibility of management statements. If the auditor suspects the company's personnel and carry out fraud, he must take into account the position of the involved personnel in the company's organizational structure.
Setting audit objectives. Auditors need to obtain evidence that supports each of the assertions for every material components of the financial report. The categories of assertions provide a framework for developing a specific audit objectives. An audit objective is an assertion translated into terms that are specific to the particular balance or class, the entity's circumstances, nature of economic activity and the accounting practices of its industry.
Management assertion is defined as implied or expressed representations by management about classes of transactions and related accounts in the financial statements. It acts as criteria that management uses to record and disclose accounting information in financial statements. 5 categories of management assertions. First, existence or occurrence. It concerns whether if the assets, obligations and equities in the balance sheet actually existed on the balance sheet date. Second, completeness. It concerns whether all of the accounts and transactions that should be presented in the financial report are included. Third, valuation or allocation. It concerns whether the assets, liabilities, equities, revenues and expenses accounts have been included in the financial statements at proper amount. Fourth, rights and obligations concern whether the assets are the rights of the entity and liabilities are the obligations of the entity at a given date. Lastly, presentation and disclosure. It concerns whether the components of financial report are appropriately combined or separated, described and disclosed. Management assertion about classes of transactions. General transaction-related audit included existence, completeness, accuracy, classification, timing and posting and summarization. While management assertion about classes of balance-related audit objectives included existence, completeness, accuracy, classification, timing, detailed time, realizable value, rights and obligations, and presentation and disclosure. Next, we are going to move to knowledge of clients' business and industry.
Industry and external environment. There are risks associated to all clients in certain industries. Besides, there are a lot of different accounting requirements that the auditor must take into account in evaluating whether or not to serve a particular client. The auditor must also consider the external environment in which a company operates.
Business operations and processes. The auditor must strive to understand how the business works. A company tour is one of the steps in getting some familiarity, particularly if questions can be directed to some of the employees. Other than that, identifying transactions with related parties is a necessary step in understanding the business. This may involve conversations with management and going through the stockholders' lists. There are 2 types of business risk, and those are audit risk and auditor's business risk. Audit risk. Audit risk is the risk that the auditor gives an inappropriate opinion when the financial statements are materially misstated. Risks that the auditor delivers an incorrect audit opinion, where an opinion which states that the account presents a true and fair view, meanwhile, in reality, they do not. It measures of how willing the auditor is to accept that the financial statement may be materially misstated after the audit is completed and unqualified audit opinion has been issued. The factors that result in uncertainty in audit performance. 1. Nature of audit test. 2. Inherent limitations of an audit. 3. Inherent limitations of the effectiveness of client's internal control system. There are 3 types of audit risk: inherent risk, control risk and detection risk. Inherent risk is risk related to the characteristics of the business that may cause material financial statement. Factors used in assessing inherent risks are nature of client's business, integrity of management, client motivation, client's knowledge of accounting standards, nature of client's inventory and technological development. For example, external factors such as technological development might make a particular product obsolete. Inherent risk is high if no internal control system and inherent risk is low if internal control exists. Control risk. This is the risk that the client's internal control will not prevent or detect material errors or misstatements in the account balance. Control risk is existed due to the inherent limitation of the internal control system and inadequacy of the segregation of duties such as human error, faulty judgment. Control risk is high if the internal control system is not effective, and control risk is low if the internal controls system is effective. Detection risk is that any remaining material misstatements after assessing inherent risk and control risk will not be detected by an auditor. The risk that the auditor's substantive procedures and review FS will not detect material errors misstatements. Detection risk is high if the auditors are not competent and due care, and detection risk is low if the auditors are competent and exercise due care. Auditor's business risk. Auditor's exposure to loss, injury from litigation, adverse publicity/other events arising in connection with the financial statements audited and reported on. This risk cannot be directly controlled. For example, litigation, sanctions imposed by public or regulatory bodies, for example Bursa Malaysia and the professional accounting bodies, impaired professional reputation, which can occur as a result of litigation or adverse publicity. Next, preliminary analytical procedure. The purpose of preliminary analytical procedure are: 1. To assist in planning the nature, timing and extent of audit procedures. 2. To identify potential errors. 3. To determine areas that require detailed checking and substantive tests. The analytical procedure is a study of the relationship between elements of financial information expected to conform to a predictable pattern based on the auditor's knowledge of the business relationship between financial and non-financial information. Analyze significant ratios and trends. Investigate the relationship in order to determine whether data or account balances appear to be reasonable. Computation of key ratios are: gross profit, current ratio. Information is material when its misstatement could influence the decisions of users of the financial statements. Materiality depends on error judged in the particular circumstances of its emission or misstatement. It provides a result instead of a primary qualitative characteristic which information must have if it is to be useful. Concept of materiality. 1. It is a criterion to determine the items that require the attention and the details of the examination. 2. Materiality needs to be considered in both the quantitative and qualitative nature of the misstatement. There are two types of materiality, which are the financial statement materiality and performance materiality. 1. Financial statement materiality. When an information is likely to influence the economic decisions of financial statements users, it is considered material and should be disclosed. 2. Performance materiality. Auditors will determine the amount of performance materiality to leave room for error and reduce the probability that the total misstatement exceeds materiality. 1. Single rules. Uses a single financial variable. 2. Variable size. IT provide a range of materiality levels. 3. Blends methods. Acquiring an average. 4. Formula methods. Use mathematical formula and statistical technique. Qualitative materiality. 1. Cost. Some items are very expensive. 2. Analytical procedures results. Reduce the materiality. 3. Prior period adjustments of results. No changes. 4. Consequence of misstatement. This includes legal or contracts. 5. Importance of account balance. One of it is directors' emoluments. Thank you for watching.